let's talk about how to increase the value of your business. Now we're going to have a whole bunch of videos on this. We'll call this one Building Blocks Part 1. And we're going to focus on the balance sheet, optimizing your EBITDA, and of course the annual audits. Annual audits will do a huge difference in trying to create value for your firm. All right, let's just start with the real kind of background. Sooner or later, you'll probably want to sell your business. There's an old joke in M&A. People get really offended when you say this, but I'll throw it out there just for fun. Don't take it literally, but just for fun. There are one of three things that could happen. One, you'll die at your desk running the company. Two, you'll run the company into the ground. Or three, you'll sell the company and then enjoy that next chapter and kind of enjoy the rest of your life. But one of those three things will happen. They're mutually exclusive. Hopefully it's a good one, but it's an old joke in M&A. Don't take it too literally. All right, let's look at this one. The price. The deal's a lot more than price. I make the joke as we acquire companies that I'll buy any company for any price. You name the figure. I'll buy a dry cleaner for $100 million. But there's always a but. But I'll set the terms. And I'll buy that company for $1 a month, but hey, I'm going to buy it for that $100 million. Now, of course, that's a ridiculous exaggeration, but I want to really point out there, the deal is much more than the dollar figure that you see. It might make a good headline, it might make a good story to tell your friends, but the real value is much more than that. All right, part number two, the building blocks. The clean balance sheet. Well, when you want to sell your company, the first thing that a buyer will look for is will say, hey, give me the balance sheet. Give me the most up-to-date information. And so if there's any kind of crazy liabilities, and you know what they are, something ugly, something unreconciled, some type of litigation that's still outstanding, un-collectable receivables, or any kind of excessive write-off, well, eliminate them. Don't let the buyer have a bad taste in his mouth. Try to get rid of that thing as quickly as you possibly can. So if there's a large liability, you have a bad lease on there, underfunded retirement fund, litigation as I mentioned, or any type of regulatory affairs that looks a little bit difficult, get rid of it. You don't want to have that on your balance sheet. All right, number two. If you have any type of preferred customers, you have any kind of I don't even know what I'm talking about right there. Let's talk about those written customer contracts. If you have something, you say, oh, we have a great handshake deal, been doing this way for 20 years, that will not stand the test of scrutiny. That will not stand the test of any kind of due diligence period. And it's certainly, a buyer will think that is not going to roll over to the next ownership of the company. So if there's any type of this strange, hey, you know, we've done it this way, we've always done it this way, it's a handshake. No, get everything in writing and have something be as transferable to the next ownership as possible. A type of master sales agreement, an MSA, whatever you could do to make it as ironclad as you can. A buyer wants the lowest amount of risk, which is obvious. All right, number two, annual audits. Well, an audit eliminates risk. You're putting the numbers into a third party. You're making a new buyer feel very comfortable that things are as you say they are. Just because you have your numbers reviewed, well, the accountant doesn't offer any kind of veracity to it. They're just saying, these are the numbers we were presented and we concur based upon the information presented. Doesn't mean that much. I mean, sure, it's helpful. It's better than not having the accountant. But if your buyer really wants to have faith and the buyer really has to have confidence in what he's buying, get audited. And let me tell you what the math is. And sure, I'm kind of flying through this, but I want to make the videos concise, all right? So if you spend the money each year in the audit and you go from a 5 multiple to a 6 multiple, let's just say an EBITDA, that will more than pay for the year's annual audits you have. And then the second thing is, and this people don't really think about, there's an 80-20 rule out there. Most people say their company, they say, hey, I want to sell it to the right company, whatever the right company is. That could be culture, the way they do business, the people who operate it, the geography, the products, the customers, any and all of those type of things. But the thing is, within an industry, usually 80% of the businesses within that industry say, I want to sell to the right company, and that's 20%. So that means you're competing for their time, competing for that, I'm talking about the buyers, that 20%. You're competing for their attention, and most of all, you're competing for their checkbook. So if you want to earn their trust, earn their time, and earn their funds, you need to make them feel as comfortable as possible. And the way you make them feel comfortable, have an annual audit. This way they know what they are purchasing, and this way you can elevate yourself above the other companies that you might be competing with. Just a reminder, Sterling Concord Partners, Sterling Concord Investments. We're a boutique investment bank, and we advise the sell side to come to market and find the best possible deal for them, meaning not just money, but terms. Terms are what matter. And then of course, Sterling Concord Investments, we are actively acquiring companies between $5 million in revenue to $30 million in revenue. So shoot us a question, let us know what you think, let us know if we can help you. Thank you very much.